Welcome back to the ProTicker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today we're doing our deep dive, sifting through the key stories from CNBC, Bloomberg, Reuters, and Yahoo Finance. We're looking at everything shaping the market narrative for this week, September 8th, 2025. Our goal, to get you quickly up to speed on, well, everything from global trade shifts, the future of robotics, and what the Fed might do next. So the big question is, what are the really impactful stories emerging right now? And, what they mean for you, for investors, and the wider global economy? Let's jump in. Okay, let's unpack this. The August jobs report. That was a big headline, wasn't it? It revealed some pretty stark shifts in the U.S. labor market.
Oh, definitely. A real attention grabber.
Yeah, non-farm payrolls, according to the Dow Jones survey mentioned on CNBC, rose by just 22,000. That's way below the 75,000 expected.
A huge miss.
Right. And while July got revised up a bit, June actually saw a net loss of 13,000 jobs.
And the unemployment rate ticked up too, right, to 4.3%.
Exactly, up from 4.2%.
But what's really crucial here, and both Yahoo Finance and CNBC highlighted this, is why it rose. It wasn't just mass layoffs driving it.
Okay.
It was largely because the labor force grew quite a bit by 436,000 people. So more job seekers, basically.
Okay. So more people looking for work pushed the rate up.
Precisely. But, even with that context, it's still the weakest the labor market has looked since the pandemic era. We're even seeing declines in sectors like healthcare, which used to be a big engine for job growth. So the takeaway is really this report puts the Fed in a tricky spot, balancing that weakening job market against inflation that's still kind of sticky.
Yeah.
It's a classic dilemma.
That does lead us straight to the Fed, doesn't it? This jobs data seems to have really cemented expectations for a rate cut. How certain are we talking here for September?
Very certain, at least based on what the futures market is saying. The CME FedWatch tool, you see it cited everywhere, is pricing in an almost guaranteed 25 basis point cut, 0.25%.
Almost guaranteed. Wow.
Yeah. And what's maybe even more interesting is there's now an 8 to 10% chance priced in for a 50 basis point cut. A supersized one.
0.5%. That's up from 0 chance just a month ago, right?
Exactly. It shows how quickly sentiment shifted after that jobs report. If you connect it back to the Fed's dual mandate maximum employment, stable prices, this report really hits the employment side. It suggests things are weakening, putting significant pressure on them to ease policy, even if other inflation data is still a bit hot.
So with that labor market picture, what about the other mandate, inflation? What should we be watching this week on that front?
Right. Critical week for inflation data. We've got the Producer Price Index, the PPI, that's out Wednesday.
Okay.
And then the big one, the Consumer Price Index, CPI, on Thursday.
And what are economists expecting there?
According to Yahoo Finance, the consensus is for August CPI to rise 0.3% month-on-month and 2.9% year-on-year.
So an uptick from July's reading.
Yes, slightly higher year-on-year. And core CPI, that's excluding food and energy, is expected to match July's 0.3% monthly, 3.1% annually.
So this really crystallizes the Fed's challenge, doesn't it? Can they hit that 2% inflation target while the job market is showing these signs of weakness? Analysts like Sarah House and Nicole Cervi at Wells Fargo point out that sticky services inflation, maybe some rebounding goods prices, plus potential tariff impacts, it's all complicating that fight against inflation.
Okay, so putting this all together, what's the outlook for the stock market? Especially heading into September, which, has this reputation for being tough. The major indexes dipped a bit Friday, but finished the week up near those all-time highs.
Right, it's a mixed picture. You have the Goldman Sachs view, David Kostin, mentioned by Bloomberg. He sees the rally broadening out, maybe into small caps. He's got a year-end S&P 500 target of 6,600. Pretty bullish.
Wow, 6,600. And his argument is that Fed cuts, if they happen without a recession, are usually good for September.
That's the idea. Cuts in a non-recessionary environment often boost stocks. But then you have the other side. UBS, Simplify Asset Management, also in Bloomberg. They're more cautious.
What's their take? They worry that this weakening jobs market might actually be the start of a recession. And if that's the case, then the rate cuts are just a, quote, Band-Aid, not a real fix.
Right, a reaction to bad news, not proactive easing.
Exactly. And on that whole September slump idea, Alexander Altman at Barclays makes a good point. He argues it's often skewed by massive events.
Like 2008?
Yeah, like the 2008 crisis or the big rate hikes in 2022. Take those out, and September often looks, less negative. So you've got this real split. Rally continues driven by cuts versus cuts are a warning sign of deeper trouble.
That's a great point about context. And these domestic issues, they don't happen in isolation, do they? They're tangled up with global trade, where things seem to be heating up again, especially this legal fight over U.S. tariffs.
Oh, absolutely. Huge uncertainty there.
Wow.
CNBC and Yahoo Finance are reporting Treasury Secretary Scott Bessent says he's confident the administration's tariffs plan will win at the Supreme Court.
Confident.
But, yeah, he also warned about potentially massive refunds if they lose. We're talking $750 billion to maybe $1 trillion.
$1 trillion. Wow, that's about half of all the tariffs collected.
That's the estimate. He called that outcome terrible for the Treasury, which is quite blunt.
So what's the backstory here? An appeals court ruled against them.
Right. A federal appeals court ruled most of these reciprocal tariffs were illegal. So the administration wants the Supreme Court to take it up quickly. They're hoping for arguments in November, maybe a decision by early summer 2026.
So quite a ways off still.
It is. But it shows they're thinking ahead. NEC Director Kevin Hassett mentioned they have backup plans, other legal tools like Section 232 or maybe sector-specific tariffs. The key thing here is it's not just about trade policy. It's a major fiscal risk hanging out there. Lots of uncertainty for businesses.
And these policies, they're already having real effects, aren't they? Not just theoretical.
For sure. Yahoo Finance and CNBC mentioned the end of that de minimis rule, the one allowing small packages, under $800 in tariff-free.
I remember that change.
Well, ending it caused an 80% drop in postal traffic from 88 different countries' postal services. They've basically suspended services until they figure out compliance.
80%, that's huge.
Yeah.
Think about small businesses, online sellers.
Exactly. Massive disruption. And on the big corporate side, Volkswagen CEO told Reuters U.S. tariffs have cost them several billions of euros already, squeezing brands like Porsche.
Several billion euros. Ouch.
Yeah. Now, Trump did sign an order exempting things like gold, tungsten, uranium from tariffs, so some specific relief there.
Right.
And then you had that EU fine on Google, almost $3.5 billion for antitrust issues. President Trump immediately threatened a trade probe against the EU, calling the fine very unfair. So
Yeah.
tension simmering there, too.
Okay, so with all this happening with U.S. policy, how's China navigating this? How are they responding?
What's really fascinating, and you see this in Reuters and CNBC reports, is China's very deliberate strategy to, quote, go abroad, find other markets.
Diversifying away from the U.S.?
Absolutely. Their exports to the U.S. plunged 33% in August. 33%. And that dragged their overall export growth down to a 6-month low, 4.4%, missing expectations. Imports from the U.S. also fell, down 16%.
So what are they doing instead?
They're really pushing ties with ASEAN, the Southeast Asian nations. They just finished negotiating an upgraded trade pact in May. They want better access for agriculture, digital economy stuff, pharmaceuticals.
And is it working?
Looks like it. Exports to ASEAN countries jumped 22.5% in August. Southeast Asia is now China's top export destination by value.
Bigger than the U.S. or Europe now?
By value in August, yes. And shipments to the EU and Africa were up significantly, too. Plus, China applied to join that CPTPP trade pact.
The Trans-Pacific Partnership successor.
Right. So the big picture insight is China's actively de-risking from U.S. trade policy. It's fundamentally reshaping trade flows and alliances.
Okay, let's shift gears and move over to Asia. Some big political news out of Japan over the weekend. What happened there?
Yeah, a pretty major political shakeup in Japan reported across CNBC and Yahoo Finance. Prime Minister Shigeru Ishiba announced he's resigning. This follows pressure after his party didn't do well in a national election late last year.
Resigning. Okay.
Yeah.
And how did the markets react?
Interestingly, pretty positively, at least initially. The Nikkei 225 jumped about 1.45%, and the Kopix index hit a record high, up over 1%.
Despite the uncertainty.
Yeah, but the yen weakened quite a bit, down 0.64%, which might signal something else.
Okay. And who might replace him? Any frontrunners?
Well, two names popping up are the current agricultural minister, Kuzumi Shinjiro, and Sana Takaichi. She's seen as a protege of former PM Abe and is known for wanting deregulation.
Right.
So some analysts, like Richard Kai at Comgest, suggest the positive market reaction, despite the political churn, reflects maybe some excitement about successors who could push for more growth and deregulation. But that weaker yen, plus rising bond yields in Japan, could also mean investors are pricing in stickier inflation and maybe tighter monetary policy ahead, no matter who's in charge.
Interesting dynamic. Okay, and sticking with Asia, but looking towards the future. This headline about Alibaba investing heavily in a Chinese humanoid robot startup. That sounds like pure sci-fi.
It really does, doesn't it? But it's happening now. CNBC reported this startup, X Square Robot, just raised around $100 million. led by Alibaba Cloud, but also big names like Homshan that used to be Sequoia Capital China.
100 million. This is their 8th funding round in under 2 years.
Yeah, total funding is up to $280 million now. It shows just how fast this space is moving.
Are these robots actually doing anything yet? Or is it all potential?
No, they're already generating revenue, selling robots to schools, hotels, even retirement homes.
Really? What kind of robots?
Well, they're talking about robotic butlers being realistic within 5 years. Their COO, Yang Qinan, mentioned that.
Robotic butlers, okay.
They also just released something called Wall OSS. It's described as an open-source foundation model for embodied AI.
Embodied AI. So AI built into the hardware, the robot itself.
Exactly. Think of it like the robot's core brain or operating system. It's crucial for complex tasks. Though the COO did admit robot AI still lags behind things like ChatGPT, he said getting ChatGPT 3.5 level capabilities into robots is probably still a year away.
Got it. Still developing. Did they announce any new products?
Yes, the Quanta X2 robot. Apparently it can do 360-degree cleaning and has subtle pressure perception.
And the price. I imagine these aren't cheap.
No. Their main humanoid robot is around $80,000, although a competitor, Unitree, sells one for $16,000, so quite a range.
$80,000, yikes.
But the COO expects that price to drop significantly, maybe down to $10,000 in 3 to 5 years. That's when they think it could hit the mass consumer market.
10,000 still a lot, but much more feasible. And they're planning an IPO.
Yep, planning an IPO for next year.
So this really raises the question, doesn't it? How fast can China really pull ahead in applying AI, especially in robotics, with this kind of funding and using open source strategies?
It certainly seems like the race for household robots, and maybe industrial ones too, is seriously heating up. It's a key battleground for global tech leadership.
Okay, let's cross over to Europe now. Sounds like there's some political drama brewing in France.
Yes, definitely some political uncertainty there, as detailed by CNBC in the Global Week Ahead reports. The French Prime Minister, François Bayrou, is facing a confidence vote, likely today, Monday. It's over some pretty hefty budget cuts, around $44 billion.
And he's expected to lose the vote.
Widely expected, yes. If he's ousted, President Macron would need to appoint his 5th prime minister in less than 2 years.
5th PM in 2 years. That signals quite a bit of instability. How are markets taking it?
European stocks actually opened mostly higher. The FTSE in London, DAX in Germany, CAC in Paris were all up slightly. Italy's MIB was down a bit, though. But the real focus is on French government bonds, their OTs. They're under scrutiny, especially with a Fitch rating review coming up on September 12th. Political instability definitely makes bond investors nervous.
Makes sense. Meanwhile, the European Central Bank, the ECB, they're meeting this week too, right? What are we expecting from them amidst all this?
The consensus is they'll keep rates on hold at 2% this Thursday.
Hold steady.
Yeah. And President Christine Lagarde will probably maintain what they call a dovish bias, leaning towards potentially easier policy down the road. But she'll likely try hard not to comment directly on the French political situation.
Tread carefully.
Exactly. But what's really fascinating, and it ties into these political and fiscal worries, is the volatility we're seeing in bond markets across Europe. The Global Week Ahead pointed this out. We've seen some huge yield moves recently. Japan's 30-year bond yield hit a record high. The UK's 30-year hit a 27-year high.
Wow. What's driving that?
It's really fears about government debt levels and persistent inflation. Those fiscal worries and inflation fears are really shaking things up in the bond world. It shows how interconnected politics, fiscal policy, and monetary policy are right now.
Definitely. And speaking of European industry, there was a pretty big strategic shift announced by Stellantis, the automaker.
Yes, that was quite significant, reported by Reuters. Stellantis, that's the Franco-Italian company, owns brands like Peugeot, Fiat, Chrysler, Jeep.
Right, huge company.
Their Europe chief said they are no longer aiming for that target of selling 100% electric vehicles, EVs, by 2030.
Pulling back from the 100% EV goal?
Yeah.
That's a major reversal.
It is. And they went further, saying they believe the EU's overall carbon emissions targets for 2035 are, quote, no longer achievable for any car maker.
Wow. That's a pretty stark statement about the challenges of the EV transition.
It really is. It signals that the path to full electrification might be slower and bumpier than a lot of people hoped or planned for. A real reality check.
Okay, let's shift focus a bit to the financial sector itself. There was an interesting development around precious metals, this idea of digital gold. What's that about?
Yeah, this comes from the World Gold Council, the WGC, reported by CNBC. They're proposing something called pooled gold interest tokens, or PGI tokens.
GGI tokens, okay, what are they?
Think of them like a digital representation, almost like a digital deed, for physical gold bars stored in vaults in London. These tokens would give you legally enforceable ownership of a piece of that vaulted gold. It would allow fractional ownership of those big 400-ounce bars.
Fractional ownership of the big bars. So you wouldn't need to buy a whole bar.
Exactly. Makes it more accessible. And crucially, they could potentially be used as financial collateral, like you'd use bonds or other assets.
Interesting. And the London gold market is huge, right?
Massive, valued around $930 billion. And gold demand has been strong this year, with all the market volatility, geopolitical stuff, economic worries. So the WGC's ambition here, according to their head of market structure, Mike Oswin, is basically to give gold the same kind of digital mobility as bonds or cash have now. Make it easier to trade, use, and integrate into the modern financial system. Maybe even use it for futures contracts eventually.
That sounds really innovative. But I can almost hear the traditional gold bug saying, wait, I like gold because it's physical, not digital. How does the WGC counter that skepticism?
That's definitely the tension, you're right. The WGC sees this as maybe a third pillar for gold trading, alongside physical and futures. But yeah, some traditionalists, as Russ Mold at AJ Bell pointed out to CNBC, might be wary. They value gold because it's tangible outside the digital system, especially with crypto around.
Right, it's seen as an alternative to digital complexity for some.
Exactly. So this PGI token idea is really an attempt to bridge that gap. Use blockchain tech for efficiency and accessibility, but keep it fully backed by physical, vaulted gold. Trying to get the best of both worlds, potentially broadening gold's appeal.
Got it. Okay, finally, let's look at the world of private equity. Sounds like the competition for talent there is really fierce right now.
Oh, absolutely fierce. Cutthroat, even. A report from Magellan Advisory Partners, mentioned on CNBC, showed PE recruitment really ramped up in the first half of 2025, especially for roles involved in raising money, fundraising, investor relations, marketing. Firms are apparently overpaying to get the best fundraising talent.
Overpaying. Why the focus on fundraising now, especially if deal-making has slowed down a bit?
Well, deal-making has slowed because of higher rates and volatility. But the big PE firms are sitting on a mountain of cash, nearly $1 trillion in dry powder, undeployed capital.
$1 trillion waiting to be invested.
Exactly. So they're staffing up now, positioning themselves to deploy that capital quickly when conditions improve, maybe with those anticipated rate cuts. They want the best teams ready to go. And it's not just U.S. focus. You see the mega funds like Apollo, Warburg Pincus, Carlyle, they're expanding aggressively in Asia, Japan, Southeast Asia, India.
Makes sense. And I heard they're actively poaching from Wall Street investment banks.
They are.
Yeah.
Reading the analyst pool is pretty hard, which
Right.
is forcing the banks to react. You see JP Morgan putting in rules like an 18-month minimum tenure before analysts can leave. Goldman Sachs reportedly asking for a loyalty pledge. They're trying to hold on to their junior talent.
Loyalty pledges. Wow.
Yeah. Meanwhile, the PE firms are building up their own in-house training programs, so they're less reliant on just poaching trained bankers.
So what's the big draw for talent to move to PE? Is it just salary?
Salary is part of it, but the really unique thing, especially at senior levels, is carried interest.
Carrie, explain that quickly.
It's basically a share of the profits the fund makes on its investments. And crucially, it's usually taxed at lower capital gains rates, not income tax rates. So successful partners can potentially make vastly more from carried interest over the life of a fund than from their annual salary. It's a huge economic incentive.
Got it. A very powerful draw.
Definitely. And this whole talent war raises a big question. Is it creating an even bigger gap between the giant multi-strategy PE firms that can afford to fight these talent battles and the smaller firms that might struggle to raise funds and compete for people?
Yeah, could it reshape the whole private equity landscape, leading to more consolidation?
It certainly suggests that. A continued consolidation of power and a relentless focus on getting the right people in a super competitive market.
So as you can hear, all these stories we've touched on, they're really deeply interconnected, aren't they?
Absolutely. Nothing happens in isolation.
Right. Central bank moves affect jobs, which affects markets. Trade policies ripple through supply chains globally. New tech investments like robotics could reshape labor markets. Each headline we've unpacked today is like a piece of a larger puzzle, helping you build a more complete picture of this complex financial world we're navigating. They're all threads in this global tapestry influencing each other. So here's a thought to leave you with. As we see this huge flow of capital into things like humanoid robots and ideas like digital gold gain traction, are we maybe on the verge of fundamentally redefining what we mean by value or labor? Are we moving beyond the usual economic cycles Or are these just sophisticated new tools and technologies helping us navigate the same kinds of market ups and downs we've always seen, just maybe faster? Something to chew on. We'll see you all tomorrow morning with new headlines from major financial magazines.